Hi, my name's Chris Tubby, founder of Trading for Tomorrow, and here I'm just going to share some macro outlook with you. Okay, so this is the macro outlook, so let's just take a look at what happened last week to start with. So, the previous week most markets were oversold, especially the stocks in the short term. But buyers were very patient and they were waiting because they was trying to look for bargains. Markets just continue to be impacted by these uncertainties surrounding rate cuts, inflation, and of course the geopolitical issues that we're experiencing at the moment. And as the week went on, the stocks bounced, and that was even despite the fact that the data coming out, especially the US, was pretty mixed. Stocks are up 23% year on year. Although that said, they're down around about 2.4% at the moment, month on month. Earnings were coming out mixed, although there was some good performance from Alphabet, Microsoft, and Snap. They easily beat expectations. And of course, the S&P and the Nasdaq responded to that, and they moved up pretty much all week, making higher highs and higher lows as well during the week. And of course, with those companies having such good performance, Nvidia had a great week. It rallied 15% because there's the expectations that those companies are going to keep investing in AI, and that the spending is going to increase, which is going to benefit Nvidia a lot, obviously. And then when we look at some of the other data released in the US, GDP came in much weaker than expected for Q1. Although I've got to say, if you do a deep dive into that data, it wasn't as bad as it looked. PCE was pretty much in line. However, the core still at 2.8% year on year. And that just keeps pushing any chance of a Fed rate cut further along. And now perhaps that maybe even right till the end of the year. And of course, with the election in November, I doubt whether Biden's going to be very happy if there aren't any rate cuts before the election. Because, Americans do seem to sort of focus a lot on inflation and interest rates. And if you look at the 2-year yields, they're close to 5% again, after that dropped off a lot with the expectations that the Fed were going to be starting cuts. Beginning of the year or end of last year, everyone was expecting a lot of cuts this year. I only expected 3, but even so, the chance of that's out the window now. So consumer spending is now being driven by borrowing, households dipping into savings, definitely rather than from wages. Demand sort of makes it look as though inflation is in no rush to drop to 2%. Well, especially in the US, just because their economy is still so strong. Europe's a little bit different. Europe seemed confident that they would achieve their inflation target. And the chances of an ECB rating cut in June still probably quite high. Now, that said, conditions in Europe do seem to be improving. Even German data is coming out more positive finally. Oil had a steady week. It finished pretty much on the highs. Nat gas has broken out on the upside as well. Then on agricultural, we've got wheat, corn. They're also moving higher. Coffee's moved higher because Vietnam's holding back their crop. Cocoa's over 250% up year on year. Obviously, as a chocolate lover, that's damaging for me personally. But all of that is just inflationary again. So I can't see that 2%. It's always that case as it gets closer and closer to that 2%, it gets stickier. But we're starting to see a few more fundamentals that could actually move inflation just up slightly rather than down. And then, of course, when we look at the geopolitical situation, now Ukraine should start to receive some of the financial and military aid, so they should start to get that influx of weapons that they need so desperately. And to be honest, they've needed them for a while now, but it's all been held up by politicians. And with Russia sort of forcing Ukraine forces back quite easily, I mean, they outgun the Ukrainian fighters at least 5-1 at the moment. And of course, now the question is, will Ukraine get those supplies in time? Hopefully, yes. Support for Israel seems to be sort of waning a little bit now. Most seem to be against any major attack on Rafah. The Red Sea is still a hot spot. Ships aren't prepared to take that risk, and that, of course, that adds time and cost to the shipping of those goods. Over 80% of global trade is transported by sea. So all of that's trying to take that shortcut into Europe and now having to go around Africa, and that's adding to that time. It just increases expenses again and costs. So therefore, again, that could still feed into inflation. It's one of the reasons, another reason why we're not seeing that inflation coming lower. So if we look at what's coming out this week, we've got FOMC, but I just don't see that bringing any surprises. So the main focus is going to move across to the employment data. So, obviously we get the jobs, ADP, etc. coming out, jobless claims this week, but NFP on Friday, probably looking round about 200,000. But to be honest, I don't really take that much notice of the actual number. I find it a little bit misleading because if you look at full-time employment, that's pretty much at a 16-month low. And a lot of those full-time jobs are being replaced with part-time jobs because they are on the rise. And of course, part-timers tend to earn less, and therefore, I don't believe that that's really so inflationary. Where I focus is much more on sort of the average weekly hours that are worked and the average weekly earnings, because I see them more as the risk to inflation. This week we've also got a few PMI numbers coming out from various countries this week. In Eurozone, we've got CPI, the minutes from the last Bank of Japan meeting are going to come out. And then earnings-wise, we're going to see Amazon, Starbucks, AMD, McDonald's, Coca-Cola, and obviously others reporting this week. Interestingly enough, by the end of this year, there's going to be a new futures exchange open. But when I look at the companies that are involved in that, personally, I'm going to avoid it. I prefer not to swim with the sharks. They're going to tout and offer cheaper fees and all that, but it's not going to compensate for the potential losses and manipulation that could possibly go on there. I'm not saying it's going to, but it could. So for me, there's just too many predators that are going to be lurking in that new exchange. But remember, that's just my personal view. So finally, we're going to be at month end over the next couple of days. So expect some rebalancing, especially if you're trading the stocks. Now, next weekend is going to be a long weekend for many countries, especially in Europe, because it's May Day, etc., etc. Now, all that leaves me to do is just to wish you to have a great week. Now, I just want to sort of just talk a little bit here about my services that I offer. So there's a daily newsletter that includes global news, headlines, my views, full articles. That is a subscription service. There's one-day workshops. This will help you to discover if trading could be your next career or even just a second income. Otherwise, maybe you're already trading, but there's a few gaps that you'd like to fill in, and I can help you with that because that will accelerate your trading and your performance. And then there's a 1-week intensive course. That's going to make you feel competent and confident after just 1 week. It's going to give you those foundations that you need to build your trading career on. And if you've got that in a trader, we'll find it. And now that does also include a free trading challenge. Then I do a Flexi Masterclass, which includes 6 weeks of guided learning. They can be split up. You don't have to take them all at once. And this is designed to provide you with all the knowledge and trading tools that you're going to need to navigate any market and also on any asset class. I trade them all. And as I say, you can spread those weeks out over months if you need to. It's no problem for me. And again, that does include a free trading challenge. Now, trader mentoring, I'm doing more and more of this. And this is to help you reach that next level time and again. And I'm doing much more in the way of one-on-one sessions right across everything that I'm doing now, rather than sort of looking for big groups. I do provide a lot of trader educational content to individuals, exchanges and brokers. And as I mentioned earlier about the trading challenges, if you're looking for a funded trading account, then you can contact me for details just about the ones that I use, or you can sort of take one of the courses where I'll give it to you for free at the end of it. Okay, so then moving on to our disclaimer, just to make you aware that trading does involve the potential risk of loss of capital and is not suitable for everyone, although hopefully it is for you. And many companies provide leverage, so just be aware that you can lose substantially more than that initial investment. Everything I include in here is just purely for educational purposes. I'm not trying to encourage you to trade or invest. That must be your decision. And of course, before you make that decision, you've got to consider the risks involved, definitely your financial situation, your level of experience, and your risk appetite. And of course, it's important that you only risk capital that you're prepared, but also that you can afford to lose. And if you've got any doubts whatsoever, seek independent financial advice and do that before you risk your capital. So many people come and find me after they lost money, which is sad. They should come to me before. And yeah, so listen, that's it for part 1. I hope to see you in part 2, where I'm going to do some technical analysis.